Weaker in the near term, a little better in the medium term. How do you read it?
Hi, Brian. Nice to see you, too. Well, it's true that this quarter has been this mixed bag where you've had some stocks that were really decimated for the first 3 quarters of the year, or the first 11 months of the year, start to really show something that's coming up in a better way. And that's a function of the numbers just getting to a point where value investors start to look around and say, gosh, here we are at 3,600 on the S&P, and maybe we can move that needle up. And so we've hit 3,800 on the S&P 6 times since June. 6 times the market's gone up and down and up, and it keeps sort of crossing that 3,800 level, which is happening, today again. And it shows that there are some buyers that come out of their bunkers in the cellar and they buy Meta, or they buy a little PayPal, or they put more money into the names that have been working, whether it's energy stocks or O'Reilly. But there have been some ways to make money despite all of the carnage, because we've seen lower inflation numbers. We've seen some improvement in PCE. There are some signs that at a certain point, the Fed's going to stop hiking and earnings estimates are going to stop going down. And so for the brave, for the intrepid, I think that you can make a case, but the market still has the jitters and investors are very negative.
Well, I mean, Rob, Kerry's nailing it on this 3,800. I mean, it seems like, to use a war reference, the Maginot Line. I mean, that 3,800 on the S&P, just testing, resistance, testing, fail, up, back. Now it's holding. I mean, I know we're all not technical analysts here, but that number and that seems really critical for the macro market. Yes?
You have to respect the technicals here. There's no question about it. We've been talking about technicals all year and kind of selling when you reach the upper end of the 200-day moving average, which is about 4,100, just slightly shy of that, and then adding to exposure as you get to the lower end of that range. And so right now, we are still in a downtrend. We haven't been able to get enough news to allow us, Brian, to meaningfully break above that. And why is that? And it's because the central banks are still in inflation tightening mode. Yes, there's data that's indicating some softening, but the Fed is still pushing back against what markets are telling us. In addition, you have the ECB and the Bank of Japan. It shows that the largest central banks of the world are also in inflation and tightening in mode. And so 2 softer CPI prints are not enough to allow markets to kind of break out of this. And when you have upward pressure on yields, it puts downward pressure on stock valuations. And we're not going to be allowed to achieve that technical escape philosophy. And that is why we have continued to be negative. We continue to be cautious. We will not chase anything higher. And frankly, the growth stocks are still at the most risk for falling. And that's really the reasonably priced growth stocks you can look at, but most growth stocks still trade at a premium to the market. And so, valuations aren't compelling until you get to the lower end of those ranges. We are just saying respect the technicals.
The technicals, and also, Bryn, I would respect the money flows, and they have not been good. I'm going to read something here from Bank of America to make sure I get it right, my old eyes. Bank of America noting $27.8 billion in outflows from what they call passive equities. That is a record. So you wonder why we're weak? Well, it's always more sellers than buyers, or the opposite. You can insert any reason you want why, but here's the reality. There is a lot of people dumping stocks. Is this just some kind of tax loss selling heading into, when the calendar changes, things will turn? What's your take?
I think that of course you have some of that. And I wouldn't read too much into the weekly fund flows. What I would read into is where the real flows are coming and going, and that's with the central banks. And so you have globally, all now major central banks are tightening. Globally, you have quantitative tightening on top of rising rates. And I just think that's going to continue to put this pressure on a lid on valuation.